Okay, today we want to go into chapter 13 in your book, The Cost of Production. Um, in this chapter, we're going to get into a lot of calculations in terms of what we mean by cost of production. We're going to go through what we mean by the cost of production when it comes from an accounting standpoint, and also when it comes to an economic standpoint, and the two are dramatically different. The key to this whole section is the thing I've mentioned before in terms of costs and running a business. The guy with the low cost wins because he, of course, can survive a price war and produce and sell the goods at a lower cost, a lower price than any of his competitors. So the cost of production is very important in microeconomics, and we're going to look at this in terms of how the firm looks at its costs, both from a little bit from accounting point of view, so you know the difference, and the other from an economics point of view. So let's go. So we're going to deal with, in this chapter, the cost of production. By the way, this is a very important chapter for you to understand in the book because the author does an excellent job of going through an explanation of what we're talking about here in terms of unit costs. And we'll spend some time on it in class before you take the quiz as well. And the author even admits that this is somewhat of a difficult concept to get your arms around, but it's a very important one from the standpoint of a business and also from the standpoint of understanding economics. So this chapter deals then with the cost of production, and every business has it. Every business looks at it. They are concerned about their costs on a daily basis. It doesn't matter how large you are, how small you are, because keeping your costs down makes you competitive. If you're competitive, you can sell product in the marketplace. So there's two key elements to remember and differences, major differences. From an accounting standpoint, accountants are concerned about profit and loss. In economics, we're concerned about the margin. What happens at the margin? In other words, what are the marginal revenue issues and what are the marginal cost issues? Now, from an accounting standpoint, let's discuss that a little bit further. Accountants look at costs in terms of how am I going to be able to make a profit? So they're concerned about total revenue, they're concerned about total cost, and what does that do to the profit or the bottom line? In economics, we're concerned about the change or marginal revenue, and we're concerned about the marginal cost. So in accounting, profit and loss, accountants are dealing with numbers in total. In economics, we're dealing with numbers per unit costs, per unit revenue. Okay, so understand the difference. The accounting concept is gross profit and revenue. The economics concept is unit profit or cost and revenue. So, as I said earlier, he who has the lowest cost wins. That's the rule of business. The lower the cost you have, as I've said over and over again, is that you are the one who can perform the best in the marketplace, offer the product at the lowest cost to the consumer or whoever your purchaser is. It also applies in international trade, comparative advantage, which we studied earlier in the course. So in doing this, putting this together, we're going to deal with fixed cost, variable cost, and total cost. Now, when we talk about fixed cost, variable cost, and total cost, we're talking about cost per unit. So in every case, we're always dividing the units into the total fixed cost or the total variable cost or the grand total cost. So we have to remember, however, that in business, all costs in the long run are variable. It doesn't matter what it may be, businesses can always reduce that cost. It doesn't matter whether you're talking about facilities or equipment. You can always, for instance, the ultimate reduction in cost, of course, is bankruptcy and going out of business. But you can always sell off a plant, you can sell off a piece of equipment. You can't do it quickly. You can do it in the long run what we're going to be concerned about mostly here is the short run. All right, so accounting for business profit and loss. Business accountants and accounting look at a financial statement, and that's what they're concerned about. Number one is sales, and sales in businesses are recorded as total revenue. So how much of our product have we sold in this period? The period may be the quarter, the period may be the year, whatever period they are covering. The next piece would be the total product cost. This is the sum of all costs like materials that are consumed in the production process. They can be fixed or variable, but usually they're fixed. This would be the case of in the computer business, when we make microchips, we scorch or put impressions into silicon. That silicon would be what we would call total product cost. Then next comes gross margin. And all that is the difference between the total product cost less the total revenue gives us what we call gross margin. Next comes operating expenses, and those are expenses primarily associated with variable costs, like payroll, advertising. You know, the business gets in trouble, a lot of times one of the first thing to go is advertising. They try to keep people on as long as possible, but advertising is easy to get rid of. So their end result from an accounting standpoint would be gross profit, and it would be after paying all fixed and variable costs, and it's before we pay any dividends or taxes. So that's probably what we mean by gross profit. It's also sometimes called operating profit. Okay, let's move on. Now, converting total cost to average cost. How do we do that? Total cost previously described can be converted to average cost by dividing each by the number of units produced. Now, recognize here we're talking about the factory or the business or the firm. So we're not talking about the units that were sold when we talk about costs. We're only talking about the units and the money that we spent to produce those units. So it's the cost side of the ledger. So we're going to measure what's called the production function, which is taking the inputs and putting those into the production function, resulting in output of a good or service that could be sold in the marketplace. So when we talk about the production function, what we mean is the quantity of units used to make the good divided by the quantity of outputs from that good. That is the production function. You need to understand that concept. So the result of all of this gives us the ability to look at our costs. And we are, as economists, very concerned about our costs because, again, costs are very important. Costs are the key to our survival. So we talk about marginal costs at the various levels of production, the average cost per unit. Average costs. Here's a schedule that shows output over time on the lower axis, the upper axis, costs and revenue. So if we look at average total costs, we look at average variable costs, and we look at average fixed costs. And you'll see over time, average total costs reach a low point and then start to climb. Average variable costs do the same thing. They reach a low point and then they start to climb. Average fixed costs, however, as you produce more units and divide it into the average fixed, the fixed cost, the fixed cost tends to continue to decline over time because we're producing more units and the cost stays fixed, as with the definition of average fixed costs. So variable costs, we start to hit a point where the cost increase faster than the revenue does. And we're going to talk some more about that. So the more we produce, the key here is the more we produce in output, the lower the cost, the average fixed cost per unit goes. The variable costs are different. The variable costs tend to increase. So the impact of the variable cost plus the average cost gives us the average total cost. The average total cost is a big function of the average variable cost and what happens to that variable cost. So average cost in the long run. This cost chart depicts what happens in the cost per unit, both in the short run, in the medium run, in a short run with a large factory, and then the average total cost in the long run. And you'll see that what happens is that the costs tend to, over time, we tend to be able to reduce costs over time. The longer the period, the better. But at some point in time, the average total cost in the long run starts to increase. And this is called diseconomies of scale. We can no longer produce product because we've exceeded our problem, our amount that we can produce, and our costs are going to increase. Now, take for instance, we may be applying too much labor to our production. And as a result, the costs resulting from the increase or too much labor, the cost will continue to increase. So economics versus finance. In finance, explicit costs are measured by the outlay of money by the firm to complete the task. So these in finance are called explicit costs. We know exactly what they are. We can see them on a financial statement. These are explicit costs. So how do we determine profits in finance? The profits are measured by deducting all the costs from the sales revenue. And the cost we're deducting in finance is explicit costs. In economics, we work with implicit costs. The cost that are associated which is given up or sacrificed and requires no outlay of money. Economic profit involves subtracting all costs from sales plus implicit costs. So let's talk about that a little bit because the concept is a little bit difficult to understand. It takes a little bit of concentration. So if we talk about implicit costs and what we've given up is maybe or maybe not results in an outlay of money. Let's talk about a person who decides to leave his job and go into business of his own, start his own business, maybe a donut shop, it could be a little store, it could be a home-based business, whatever. When we talk about implicit costs in economics, we mean what's the cost of this person? What is the cost of what he gave up by having a job to what he's going to incur in his own business? Or if you want to look at another way, the implicit cost would be the free time he now has by not having to go to work versus the amount of time he's going to use to start this whole new business. So there's no outlay of money in that, but the cost associated with that is what that person gave up to go into business for himself. And basically, as we said, since he left his other business, he gave up his leisure time and he's going into a business of his own. So economic profit involves subtracting all costs from sales plus the implicit costs. So when we talk about costs in economics, we're talking about not only the costs that we can see, like the explicit costs, but also the implicit costs of what we've given up to go do what we're doing now. So economic profit is usually lower than financial profit. Economic profit, again, is something that results in, may or may not result in an outlay of money. So what we do is we account for everything, including in the example I gave you of leisure time. So by definition, because we account for the loss or what we gave up in leisure time, our profit is always going to be lower than the financial profit. So I don't know how else I can explain that other than, well, the examples I've given you. Make sure you spend some time going through the chapter in the book because he goes into pretty good detail on this whole concept. All right, marginal costs. We've talked about this before. In economics, we're always talking about the margin. We want to know what the change is. So marginal, in our case, always means change. Okay? We measure the change. We're not measuring absolutes. We may be deriving the cost per unit, but what we're really interested in is what is the change in the cost per unit given an addition of cost or an addition of, let's say, more product. That's what we're concerned about in economics. So production process, we have to be aware of marginal costs because we have to be careful about if we increase production beyond a point where the law of diminishing returns starts to come into effect, as we saw in that chart, and the costs, our unit costs go up, and therefore we put ourselves at a disadvantage in the marketplace. We want to be sure we stay in what I call the sweet spot from a business point of view. So marginal cost is the increase or change in total cost for each additional unit of production. Again, we're talking about unit cost, not total cost. Average cost and marginal cost. The relationship between the average total cost and the marginal cost are depicted here. If you look at the first bullet and the chart above, it says that if the marginal cost is below the average total cost will decline toward the marginal cost. Secondly, if marginal cost is above the average total cost will increase. And thirdly, the marginal cost intersects average total cost and average variable cost at the minimum points. Now, cut through all that, and really what we're talking about here is where is the point at which we should be doing production? What is our sweet spot? And if you look at the chart, it's obvious that our sweet spot is where the average total cost is at its lowest point, where the average variable cost is at its lowest point, and in fact, the marginal cost will always intersect those two cost curves at that point. So marginal cost is above average total cost, and marginal cost is above average variable cost. Where it intersects those two curves are the sweet spot for a corporation where they want to do their production. That brings up the law of diminishing returns. Diminishing marginal product is another way of putting it. Comes a point in the production where the next unit of cost will cost more than the last unit produced. That's the point at which we don't want to go beyond that point because we will increase our unit costs, and as a result, we will be at a disadvantage in the marketplace against our competitors. This is, again, the sweet spot, right? Remember back earlier in the course, we talked about how does a firm respond to an increase in demand for its product? Well, they increase the demand, or they increase the production or the supply by adding overtime, by adding additional shifts, by assuming they can't hire more people. They have to extend their work day, their work hours, to include more and more production. Now, in doing that, they have to pay beyond 40 hours in Texas, they have to pay time and a half. So in the short run, which is what we're talking about here, we will always be faced with an increase in cost. Now, if we can't sell the product at a higher price, when we incur those higher costs, we're going to lose profit. Our costs are going to be higher. Okay, so again, assume your factory is producing 1,000 units at capacity. The cost of those units makes you the low-cost producer in that industry. If you decide you can make more money by producing 100 more, guess what? Those 100 will cost you more than the total per unit of the 1,000 you're already producing. So the average marginal cost, the average total cost of those additional 100 units will be more than the average total or marginal cost of the 1,000 you've already produced. Again, we can illustrate this with the cost of labor. To produce 100 more, we've got to add hours to our workforce, and hours cost time and a half. Okay. Law of diminishing returns is demonstrated by the bell curve. We've seen this before. We've used it for product definition. And here it is again, and it's the same thing. As you develop a product from the beginning, you have no product and you start to produce it and you sell it in the marketplace, and you, as a result, your sales continue to increase over time as your output increases. And you reach a point where your cost curve starts to increase per unit beyond a certain point, and that is the first blue X. It's called the point of diminishing returns. In other words, our production curve has started to flatten out, and as a result, the average cost per unit is started to not be as profitable as it was before, and in fact, the unit cost is increasing over and above where it was when the curve was climbing at a rapid rate. And then sooner or later, we reach the point of maximum yield. And beyond that point, we have negative returns. So in the growth period, we have the most productive point. And as the chart shows here, the input leads to productive units. It pays to invest more time and effort. When we reach the point of diminishing returns, each added unit leads to a decreasing rate of output. It's best to stop somewhere within this phase. That's an important point. When you start to see diminishing returns occur, you're probably at the point where you're not going to make as much money on additional units. And maybe you want to look at another product to continue to grow your company. And where you definitely don't want to be is where the last point of maximum yield is, where you start to get negative returns. Okay. Economies of scale. Okay. Production units that continue to yield a cost per unit of output, where the long run average cost curve falls as we did more units of production. So the average cost is declining as we move up that curve. Sooner or later, we reach a point where that cost starts to increase. And that whole concept is called economies of scale. We want our production to reach an economies of scale where we know we have a lowest cost, and we don't have to go beyond that point to produce more units. Diseconomies of scale are the opposite. Additional units cause long-run average cost to rise. So with economies of scale, the average cost is still coming down. When we hit diseconomies of scale, the average cost is starting to rise. Constant returns of scales mean that the average total cost stays the same as the output increases. So three things: the economies of scale, which means that we are, as we go up the curve and produce more, we are yielding lower and lower costs per unit. When we hit a point on the curve, we incur diseconomies of scale, which means that our costs are starting to rise. Constant returns to scale means that the average total cost stays the same as an output of a unit increases. So you can have economies of scale where you're improving. You can have diseconomies of scale where you're not improving and you're actually losing and your costs are rising. Or you can have constant returns. This is where you are selling, your cost is staying constant, and you're probably in good shape. So economies of scale continued. Here it is graphically. If you look at the chart, you'll see unit costs are falling as output increases. Output is on the bottom axis, and the average cost is the vertical axis. Now, as we move down that curve, our costs, as you can see, continue to decrease from quantity 1 to quantity 2 to quantity 3. At quantity 3, we reach the point of diminishing returns. And what happens is the unit costs start to increase, and we incur what's called diseconomies of scale. So this is graphic representation of what we just talked about in the lecture. Okay, so the cost curve comes down as we produce more and more units, but at some point in time, that curve will start to increase when we've produced our optimum point. Okay, so let's stop there. That's that chapter 13. We'll spend some time on it, more time on it in class next Thursday. But it's important that you spend a lot of time understanding that chapter, read it. If you have to read it more than once, please do. If you need to go through this lecture more than once, please do, because these are kind of different concepts than what we've been dealing with up to this point. But it's a very, very important concept. You go to work for a corporation in the business environment, financial analysis, as I did, you're going to have to know how to calculate these costs, understand these costs, so you can effectively talk to management and make management recommendations. So once again, have a good weekend, and I will see you next week.